Hello and welcome to Personable, a podcast focused on speaking to the world's best, enabling you to become the best that you can be. Today, I'm honoured to be joined by Lucy Baldwin. Lucy is a Managing Director and the Global Head of Research at Citi. She is responsible for managing Citi's global independent research across all asset classes. Lucy joined Citigroup in April of 2021 from Credit Suisse, where she was Global Head of Equity Sales. Prior to Credit Suisse, Lucy was at Bank of America as Head of European Equity Sales from 2015 to 2019, and at Goldman Sachs as the Director of European Equity Research, and a variety of other research analyst roles from 2006 to 2015. She began her career at Cazenove, if I'm saying that correctly, as an equity research analyst covering the building materials sector. She also graduated from the University of Birmingham in economics. I feel incredibly honoured to speak to Lucy today. She was one of my favourite speakers when I ran the Investment Society at Eton, and so it's great to be able to transition from that, I think 4 years ago now, to having her on Personable is incredible. So I wanted to get started, Lucy, by asking you a few questions. What is a research analyst? Why you became a research analyst? And what makes a good research analyst?
Harvey, thank you. It's great to be on your podcast. And I think what you've built is phenomenal. So it's a huge inspiration to lots of young people out there. So well done. And thanks for having me on. Let's dig in then. What does it sort of take to be a good research analyst? Why did I go down that path? I suppose when I was at university, I didn't really know what I wanted to do, right? I had no idea. I was an estate agent while I was studying and I loved it, right? I absolutely loved the buzz of selling houses, syncing up people with properties and all of that kind of thing. It was a really great learning curve as well, because also it helps you kind of deal with knocks and blows and people saying no. So it was a great training for life in many, many ways. But I had no idea what I wanted to do afterwards. And I suppose at that stage, I thought maybe I'd stay in property because it was so fun. But my university boyfriend said, no, come on, let's leave Birmingham and go to London. Let's apply for some jobs at some different banks. And so I applied to a bunch of different graduate schemes, and I was lucky enough to pick Cazenove, which again was through many ways luck rather than particularly great judgment. But what was so good about it was a pretty small UK-centric firm, so the amount of learning that I had to do was pretty contained. And I often tell graduates today, back in those days, 20 years ago, when I was covering a bunch of UK-listed companies, they had all of their business pretty much exclusively in the UK. That's how they competed for profit with one another in the house building sector, where I sort of learned my trade, as it were. And they had pretty much all UK equity fund managers as their shareholder base. So they were competing for equity capital, again, in a very UK-centric, closed kind of way. And I always think it's a good sort of starting point because it shows how far the industry's come in 20 years. But it's also an illustration of how much easier the job used to be and how much more complicated it's got because the world has globalized. I know there's lots of debates around where we are in that thematic and whether globalization's over and all those sorts of things. But ultimately, back in the day, it was very different, right? And I think what's so fascinating is it was certainly an easy way to start for someone like me who had no financial background. My family weren't involved in finance. My mum was a hairdresser. My dad worked at a local factory in Shropshire where I grew up. And so it was quite a soft landing into the world of finance to go to Cazenove to see how everything would fit together, whether that was the investment banking piece, sales and trading, research, even the wealth management piece. It was a fairly small firm in those days. It then got taken over by JP Morgan. And so the brand has sort of lived on within JP Morgan. But that was sort of my path, really. I was lucky enough to start on that Cazenove graduate scheme where I got to rotate around the firm, understand and see how it actually fit together. I certainly thought in the early years that I wanted to be a banker, and I'd read Barbarians at the Gate as a student, and I thought that all sounded very exciting, LBOs and sort of world of high finance. And I think, my sort of rotations through the investment banking division were good fun, but I probably realized it was a very sort of hierarchical setup. And I can remember looking and thinking, gosh, those research analysts, whatever they are and whatever they do, look like they're having a good time, right? They're out seeing CEOs and CFOs of companies. They're telling boards strategically what they could and should do. They're talking to investors around what's going on and how to think about the company and its prospects. They look like they're in a real sweet spot. And so at the end of the sort of grad scheme and the rotations, I managed to get a role within the research department. I was lucky enough to work for a great analyst who spent a lot of time investing in me, teaching me, helping me understand what this research role was, etc., and how you can be really good at it. And I suppose most of my career was probably shaped by some of those formative years at Cazenove, covering initially the building materials sector, the UK house builders. And then, subsequent moves that I made were sort of building on those foundations. So when I look at it today through a different lens, perhaps a lens of looking after a research department at Citi with over 800 people around the world covering 3,600 plus stocks and rate strategists, commodities research analysts, FX strategists, credit analysts, etc., like the full suite, as well as over 50 economists around the globe. Obviously talking to lots of different types of clients every day, whether it's pension funds, sovereign wealth funds, whether it's hedge funds, etc., asset managers, family offices, the list goes on, right? When I think about it today and I sort of try and pull it all together, the most important traits are curiosity, right? That intellectual curiosity, that drive to keep learning, to think differently, to be bold and creative about how the world's changing. And I try and boil it down for young analysts today that are just starting out. I try and ask them to think about the profit pools and the revenue pools that they're analysing. How are they shifting and changing? Which are the companies that are winning and losing and why? Some of those kind of Porter's 5 forces types of principles, like how are companies creating moats around their business models? How are they winning or losing market share and why? And what's the impact of that? And actually, we're filming this while I'm in Miami at an industrials conference, and a lot of the conversations I've been having here in the last few days around how is this industry shifting, and some of the different subcomponents of the industry, whether it's something like aerospace and defense, how is the defense industry shifting, right, against a backdrop of new and complex geopolitics that's continuously evolving. And the best analysts are the ones that are happy to challenge the consensus. Understanding what the consensus is important, because that's typically what's priced into stock markets and equity markets. And so ultimately, trying to work out where could that be wrong is really crucial. And if you can think about that from a 35,000 foot level, how is the profit pool, the revenue pool going to shift? How is it going to be different from what's expected today? And then apply that back to companies. It's so, it's a fascinating job, right? But you have to be prepared to be wrong, to think differently, to challenge a consensus, and to do a lot of the work that underpins that. Because ultimately, if you can do all of that, and you can say this company here is going to double its profits or halve its profits over the course of the next 3 years, and the market doesn't realize that, and here's why, those types of insights obviously generate significant alpha for clients, right? And being able to also engage with companies, engage with their boards, talk to them about what they're doing, but also give them the broader perspective that you have this privilege of seeing as a research analyst across a sector, or where different sectors intersect and bleed into one another. I mean, it's, in my mind, I'm obviously biased, Harvey, but I think it's one of the most wonderful, privileged jobs in the world. And it's one of the best places, I think, to learn within an investment bank for any new graduate that's coming out and interested in the world of finance and interested in understanding, how it works, and ultimately interested in the world around you, right? Because it's everything from every single sector in the world, right? Bottom up, what's going on, but it's also the macro top down, 35,000 feet, what's happening in the world and why. And if you're interested in marrying up those two things continuously in a sort of puzzle-like way that's constantly shifting every day and re-optimizing, I can promise that people will never get bored if they go down this path. And there's always something new to learn, which is what makes getting out of bed every day and stepping into the job a real joy.
I think one of the most impressive things about your role as being a research analyst is your ability to take what consensus is and what's happened in the past and basically move that forward. In fact, actually, just off the basis of you answered my first 1 to 3 questions, but you also answered my next 4. So that was quite funny in that I had written down that you led over 850 people. You mentioned 800, so you were underselling yourself across 30 countries, etc. But I kind of want to go into that in a bit more detail, because one of the benefits of being a research analyst, from my perspective, outside of the industry, is the ability for a singular research analyst to maybe cover 10 stocks or 5 stocks within a particular field. So they can be incredibly knowledgeable on that. And especially when you're speaking to all these big clients at all these big funds, they're expecting you to be knowledgeable and offer your perspective as well. So on that basis, kind of going into a bit more detail about the few things that you touched on just there, how do you even begin to go about leading 850 people across 30 countries? How do you stay knowledgeable across so many different asset classes? And how do you go about actually identifying out of consensus views that generate alpha?
Yeah, okay. So the leadership question is a fascinating one, right? Because obviously it's not just about me, right? It's about having a great team around you. And it's one of the lessons that you learn quickly is you've got to surround yourself with people that are far smarter than you, and people that'll make you think differently and will challenge you and make you, approach things again from a different way. Because again, it is this whole concept of being different. It's not just for the sake of it, it's being different to really think about where things are going to go and to try and predict the things that are going to happen that people haven't yet worked out are going to happen. And those things are obviously really, really difficult to do. So for me, it's been really important to have a great quality leadership team around me, and we've made some changes to that in the 4 years that I've been in the role, and that's been important to keep them challenging one another and to have, basically structure and setup and process that works. It's a good sort of lesson for life, isn't it? We all need a bit of structure and discipline, but you also need obviously some spontaneity and some creativity and all of that sort of stuff. And what we try and do with the analyst is we try and give them frameworks and guides in the KPIs that we use to measure them and their performance that really give them a sense as to what we think generally works to be a great analyst. I mean, what you realise quite early on in the research world is that there's more than one way to be a phenomenal analyst, right? Some analysts have just got brilliant corporate connectivity. Some are the best, forecasters. Some people are really good stock pickers. Some people have different aspects of what they do that they're better at than others. And you can be a brilliant analyst in lots of different ways, because clients obviously tend to speak to more than one analyst in a given sector, a given space. I was talking to a client last night who said, when he's looking at a stock for his portfolio, he will look for an analyst who's got a sort of out of consensus buy, a sort of bold, well ahead of consensus set of earnings expectations for a company. He'll look at someone who's a seller of the stock and has got a below consensus set of expectations, and he'll, as a starting point, have calls with two of those types of individuals and discuss with them what's driving their forecasts and why, right? And that's a good sort of formula for thinking about things. And I always say to young analysts, right, you've got to think about, when you understand the industry, understand what's priced into expectations, what do people expect the industry to grow at, what are the sort of natural tailwinds or headwinds to growth, and then what are companies that are doing things differently, innovatively? How are they gaining share? Is it through the quality of the product that they have? Are they doing things in a lower cost way? Are they doing things in a more capital light way? Constantly challenging the assumptions that will enable you to say this company's growth and returns profile and or the sustainability of that profile is different from what everybody expects, and here's why, right? And that's ultimately what you're trying to get to. And to your point, if you're covering a bunch of companies, like say 10 or 12 stocks, right? Hopefully at any one point in time, there's a couple of names there where you've got conviction that the market's got them wrong. And you've got conviction that people are missing something important. And that something important might be a very kind of top down, the industry's completely changing. This company has a product that is going to revolutionize the space, and here's why. And it's going to dominate and pick up much more market share, much more meaningfully than anybody expects. Could be that kind of thing. Or it could be the sort of thing where you're saying, look, this company is going to rip out a third of its cost base, and it's going to restructure a bunch of distribution centres over the next 3 years, be way more efficient, and that's going to enable it to beat earnings expectations over that period of time. And that makes the shares much more attractive than people realise. Being able to do that type of work is really, really important, and everything that goes into that, right, in terms of getting out there, spending time with companies, with industry practitioners, understanding from investors what their concerns are, what their issues are with the sector. All of that's really important. And so I guess in my leadership role, part of what I try and do is get out and see as many of our analysts around the world as I can. Sometimes at these sort of big industry conferences, that's really helpful because I can see a mixture of our own analysts, companies that we cover and care about. Sometimes it's private companies, and also obviously investors across that broad spectrum that we talk about, i.e. everything from family offices, ultra high net worths that are covered by our wealth colleagues, right the way through to the classic markets clients, which can be sovereigns, pension funds, hedge funds, asset managers, etc. So I can see a real mixture of clients of the firm, but also our own teams. And through those conversations, that's where I sort of try and get the message and the vision for what we're trying to create out. And I obviously do that as well in broader forums, town halls, other conversations. And I think, that's where sort of Zoom and other things like this make it much easier. And one of the other things we've tried to do as well is really think about and challenge ourselves on how do we get our content and our views out more to clients. And we've had much more focus in the last year or two on publicly available thought leadership content around how industries are changing and being reshaped, that we try and get out there, through podcasts, through sort of publicly available written content too, and that's been important as well. And we've also leveraged more media partners than we probably have in the past, and a lot of that is a reflection of how content and distribution is changing the world. And I only have to talk to my children, who are 13 and 8, to be reminded that the way they're getting information about the world and the things that they're watching and engaging with are just so different to the stuff that I'm sure even you, Harvey, would have engaged with, years ago when you were that age. And it's certainly night and day to when I was that age. And so I try and factor all of these things into how are we changing what we do as a research department, how are we making it more relevant, and how are we getting that view out there? Because it is a fight for mindshare. Ultimately, if you've got a really great view, it's not enough just to have it. You have to be a storyteller, and you have to get it out there, and you have to convince other people that this is where the consensus is wrong. And sometimes that means, also engaging the company, if you're an equity analyst, and say, look, this is where people are wrong. And the same principles, I suppose, apply as well, not just to being an equity research analyst, but if you're an economist, and you're covering the US, right? At the moment, you're grappling with Trump's 4 pillars of policy, whether that's immigration, regulatory reset, whether that's tariffs, whether that's taxes. You're trying to work out, what does all of that mean for growth and inflation? What does that mean for the Fed and for policy rates? And where could the market be wrong there, right? And obviously, what is the impact of that to bond markets? So the same sets of principles apply whatever you're researching, and whatever the asset class and whatever the geography. So I suppose that's how I'd try and frame it in terms of getting a vision and a strategy for the department out there, getting the analysts to think bigger and broader, to challenge the consensus in whatever their space is. But ultimately, it always goes back to, have you got a good setup and structure? Have you got discipline and process? And ultimately, are the sort of channels of communication fairly open? As you always need to get in feedback, both top down and bottom up. And as you get more senior in organizations, you also realize that you lose some of the connectivity that you had when you started out, right? It changes. The narrative that you're exposed to changes. So you've got to make sure that you are aware of your newer blind spots, and you've got mechanisms in place to get all of that feedback in. So you know how your teams feel, you know how your clients feel, and directionally whether you're going in the right place, or whether you need to pivot and tweak and adjust. Because of course, it's not just about me and my teams, it's about everybody else that we compete with, who are also out there fighting for that mind share and that market share.
Yeah, we were actually having a conversation before we started the podcast on the sort of intertwining between finance and media in the modern age. And I'm 20, I have a 10-year-old sister, and similarly to your kids, the way that she gets news and information is very different to how I got it, as you mentioned. So for example, TikTok, she knew about, Donald Trump running again for re-election before I did. But a lot of the problems with what's going on there is that's factually true that he was rerunning, but then she had a lot of different opinions on what he's like as a person or not like as a person. And so you get the intertwining of real news and fake news, which as a young developing brain isn't something that they can go, is this piece of information correct or not? Secondly to that, I think that the finance world, with how media is sort of evolving, is lagging behind. So you mentioned that sort of evolution towards podcasts. I think podcasts are some of the most consumed forms of media as more traditional media has died down. You know, when I was 5, 6, 7, 8, I was watching traditional media, didn't necessarily know what was going on, but that was where I was getting my information. But what you said about mindshare is critically important, because I think even the modern day investor, whether they're in a hedge fund or whether they're a teenager sitting in their dorm room, they're getting the information in different ways, not just from traditional sources like yourselves at Citi or from Bloomberg or from other, CNBC or other market channels, but they're using X, formerly Twitter, they're using other social media sites, which maybe they're using blogs, they're using things like Reddit. That's how that's how GameStop did so significantly well, just by people coming together. And so it's the ability of how you guys go in the next decade to going about getting that mind share, because if you're not in that space, if you're not in people's brains telling them this is what we think and this is what this is the research we have for this thing, the minute someone sees this is a buy, hold all, which means hold on for dear life, or just buy it because, or it's going to the moon, that strongly influences people's brains, which actually have a real-time impact on what's actually going on. I want to make a slight transition, as you touched on tariffs with Donald Trump and a few other topics. I have a few key topics of things that I thought would be interesting to get your perspective on. First, I want to talk a bit about AI and tech stocks. I mean, the S&P is up more than 45% over the past 2 years. The Magnificent Seven of the most top performing companies within the S&P have driven a lot of that growth. We've got AI's expansion. A lot of these notes I'm actually nabbing from a previous podcast. So if you're thinking, I said that, you did say that. You talked about how AI's expansion is leading increased power demand, impacting utilities and energy sectors, and what you called as hyperscalers, aka big tech firms, are investing heavily in data centers, which are requiring massive electricity resources moving forward. We've obviously in recent weeks had the impact of DeepSeek and how that quickly lost $500 million in market cap from these companies. So in 2025, February, the date is the 19th of February, 2025, looking over the next few months, next year, what do you think are going to be the biggest players in the markets? Is it going to be a continued trend of AI, the Magnificent Seven and tech stocks? Or do you think that investors are going to have to start looking elsewhere to generate alpha?
Yeah, I think what's going to be really interesting is to your point, we've just come through a period of 2 years of phenomenal returns for the Mag 7, right? And it would be extraordinary from a sort of historical perspective to then get a third year of that group of stocks leading the market, right? And I think what we're already seeing at the start of this year is the market starting to broaden out. Europe, Hong Kong, like China, the performance of some of those markets has already started to pick up this year. It's been a bit sort of travel and arrive, right? And so, people came into this year feeling incredibly confident about the outlook for markets. I was in Davos in January, which is always a privilege to go and be part of that and hear what people are saying and thinking. And people were unbelievably positive on this sort of continuation of US exceptionalism under the new administration. And most people, if you thought about what was happening across the street, most economists essentially hadn't really changed their outlook for growth and inflation on the back of the incoming administration. And people felt that hopefully that the policies that were coming through would be pro-growth and would be at a minimum boosting to demand and to GDP for the United States, albeit I think as we've come into the year, there've been many more question marks around that, particularly as it pertains to tariffs and what does it mean, particularly if they come into force. We obviously saw what happened with Mexico and with Canada, which I think surprised a lot of people that was the initial sort of focus. And obviously we've got a 30-day delay there, but had that have carried on down that path, you'd have had a massive negative impact to their growth and indeed that of the US. And so there's an awful lot changing in the world. And I think when you add it all up together, our expectation is, it's still a pretty positive backdrop for markets, for equities, for sure. Companies are growing earnings well. There's generally fairly good positive momentum that we're seeing. But there are many more clouds that are forming and uncertainty, not just in terms of what policies are going to come in, but the sequencing and the magnitude, how things are going to be funded. And so, the message that we've been giving to people is actually it's not as simple anymore as just owning 7 amazing tech stocks, right? You have to broaden out, and we expect the US market to see increased broadening out and to see growth coming through from other names as well as just the Mag 7. It's not to say that we're negative on that group of 7 stocks, right? I think the fundamentals are pretty strong for that group. Expectations are already that they grow at 20% this year. Now, they've had a habit in the last 2 years of delivering what we term beat and raise, right? Where they've done better than the expectation, but obviously expectations get higher and higher and higher. And so now, the expectation is another 20% of earnings today, right? So that's what they've got to beat this time to continue to deliver that same level of traction that they have. And I think that's going to get harder. Whereas the other 493, the expectations are for 10 or 12% growth, that ballpark. And we think that's more manageable. Now, the interesting thing is, right, if you're talking about 10 or 12% growth, there's other markets around the world, like, Europe, where frankly, you've got a lot of companies in that market delivering that level of growth on probably significantly lower valuations, right? Europe's trading at a massive discount still to history, even after the move that it's had this year. Certainly on a relative basis to the US, we still think there's a lot of opportunity there. So at this point in the cycle, we're encouraging people to think about cyclical diversifiers. And that could be Europe, it could be China, it could be lots of other interesting markets around the world. And I also think, for people for whom they're thinking about broader asset allocation, it's no longer just a case of, we'll just be really overweight equities. I mean, our asset allocation team have slightly pulled back the level or the magnitude of the overweight that we would recommend in equities this year because of how much has already happened in the last 2 years and how elevated expectations are. And obviously then with some of these risks around growth and possibly inflation forming a few clouds on the horizon. So again, like the only free lunch in investing, as people like to say, is diversification. And I think against the backdrop we're in, you got to really think about that. And I feel that, now is a great time for people to consider not just diversification within an asset class like equities, i.e. away from just pure Mag 7 or pure US, right? But you also want to consider diversification across asset classes. And ultimately, for those people for whom they're able to look beyond just equities, right? Usually your asset allocation decision across the different parts of not just equities and bonds, but whether it's, government debt, whether it's corporate credit, what your exposures are to things like commodities, and for people for whom they have to allocate between privates and public assets, right? Those big decisions, those big 35,000 feet decisions, that's often your biggest determinant of performance.
Yeah, on that sort of that Europe point is really fascinating, and I think I actually heard you talk about that on a previous interview as well. You've kind of, there's been a common thread in you deeming Europe to be undervalued, and I'm sure in time it will come out to be true. An analogy I heard recently, and you may disagree with this, but I thought was quite a fascinating way of looking at things. It's, let's say the S&P, you compared that to a house, and the house costs $100,000, but in these markets, it's like people have $500,000 to invest, and so they put all that money into the $100,000 house. And so I think there's kind of been a diversion away from pure fundamentals and deeming how much is this thing actually worth, and instead putting more money in it because they don't know where to put it elsewhere. Secondly to that, a common thread I've heard in terms of the pure valuation standpoint. So a stock I've been looking at, I'm currently recruiting for sales and trading, and I've made a long pitch on this company called Flutter Entertainment. They own FanDuel in the US, and they delisted over from the UK to the US in June last year. They say it's because they wanted their new headquarters in the US. I think it's because they're going to get a bigger valuation in the US. And so you're still getting that, put your money where their mouth is. That money is still in the US. And on that point about Europe being undervalued, in a similar time horizon over the past decade, the S&P has gone up over 200%, maybe even 300% in the past 10 years. Europe has barely gone up more than 50%. And then on top of that, maybe you'll disagree with me on these points, but Germany's parliament isn't as strong. I think they had a vote of no confidence. France, the president, the prime minister, and different parties. And then even the UK, Keir Starmer came in with an overwhelming majority, and people aren't as confident in what he's doing. So on that sort of scope, why do you think, there is that thing of, the US might not have that continued growth, so look elsewhere. But why do you think that Europe is the solution to that? And why do you think this is going to be the year, or the next 5 years will be any different to the past 10?
Well, there's a couple of threads just to sort of pull on there, right? So one of them that I thought was interesting is a bit about structure of the market. And I was having this conversation the other day, right? When you think about the ETFization, or the sort of the shift to passive that we've seen across the industry in my career, right? When people first bought ETFs, it was a sort of cheap way of getting beta, cheap way of getting market exposure. It was definitely a diversifier. Ironically now, it's less diversified because some of these ETFs are so unbelievably concentrated now in just a few names, right? You have to think about that dynamic and what does that mean? That's a bigger, broader question on the future for, active asset management, right? And I do think that the backdrop we just talked through is possibly more supportive from an active manager perspective than we've seen before. I also think contrasting what's happened in fixed income ETFs is interesting and important, because obviously the way that fixed income ETFs work is different, because it's all about, the debt that these companies are issuing, right? And so the funny thing obviously in equities is stocks get bigger, more successful, and then ultimately grow well, and then you see the flows pouring in behind these names, and to your point, so much money can be pouring in behind these names that it becomes sort of impossible for them to not keep going up, right? And they disconnect from fundamentals, and that disconnect can exist for long periods of time, right? And often until there's a catalyst where they miss earnings expectations or something like that to send them in another direction. You get these sort of virtuous circles where stocks or segments of the market get bigger and bigger. And that's obviously really different to fixed income ETFs. And the dynamic, I think, is always worth just sort of pondering over, because it's a completely different setup, right? You're not sort of, as companies take on more and more debt, you're not sort of chasing those companies, right? Because obviously that's probably not a great strategy necessarily, right? And so it's the whole structure of the market and indexation is fundamentally different between equities and the fixed income market. And I think that's important, because it's meant that it's been much easier for fixed income active managers to outperform versus the active equity managers to outperform, because the active equity managers, who are trying to spot these disconnects in fundamental valuation, those active managers are fighting those flows, right? And it's very difficult to do that. So I think that's an important sort of understanding for people as they think about structures of markets and how structure and setup has impacted what we're seeing in terms of product proliferation for both retail and institutional clients. And then the other piece, Harvey, that you rightly sort of highlight is many of Europe's structural challenges. And what I would say is, I think as an analyst, you try and learn that there's a price for everything, right? And we're not out there saying that every company that we're a buyer of is a brilliant, great quality, fabulously run company that's flawless by any stretch of the imagination. And the same is true that it is not fair to say that every company that we or other banks are sellers of or have an underperform recommendation on are bad companies. It is really a measure of what you pay for what you get. And it goes back to growth and returns, and the sustainability of those ultimately shapes the valuation of those companies. And that's really, really important, because the same is true when you're thinking about economies and economic growth, right? And whether you would want exposure to Europe, right? Again, many of those issues that we talk about with Europe's challenges that have gone on for pretty much all of my career are incredibly well known and understood and baked into expectations and the price. And sometimes it means people get so negative and so bearish about the outlook for growth and returns in Europe that there are just opportunities to be invested and to actually have really good performance, right, because of that disconnect. So it's definitely not to say that Europe hasn't got all these challenges, because for sure it does, right? And Europe is absolutely wrestling with how does it do its own version of Trump 2.0? How does it regulate? How does it rethink growth? How does it free up and cut away the red tape and the bureaucracy? And how does it stimulate innovation and get productivity growth back in the workforce? All of those things are really important. And I think it's just about recognizing that there's always, a price almost for everything at any point in time. And I think understanding that is one of the early lessons of investing. It's not just a judgment call on this is a really great company, because obviously sometimes there are brilliant companies doing amazing things, but where expectations get ahead of themselves and actually you have a period of performance that is disappointing in the share price because the company can't quite live up to those lofty expectations. So that constant recalibration of what do people expect, and what is realistic in a given time frame is really, really important when you're thinking about the macro or the micro.
From an energy standpoint, something I did A-level economics, and similarly in that year when we spoke, there was an energy shortage, particularly coming out of the pandemic, and I think there's still a big problem in the UK and in Europe. There was that over-reliance on Russia through the Nord Stream pipe, and then they shut that off at the start of the Ukraine-Russia war. Adjacent to that, Donald Trump has talked about, getting back into oil and gas in the US and pumping that out to get the US's own reserves to decrease that over-reliance. And then obviously you've got Saudi Arabia and Russia who basically have that, the price control in their arrangement, basically decide how much oil costs throughout the world. But something I found really interesting is that Saudi Arabia, through their 2030 vision, and I actually spoke to a senior economist at the PIF recently, and he was saying that Saudi Arabia is trying to, go more towards renewables in the future. And obviously a lot of people say they're going to do things and do them or don't with Saudi Arabia, the US, the UK, etc. I'd be curious on your standpoint of where you're seeing the global energy coming from in the future. Is it going to be a continued reliance on non-renewables? Are we going to get to renewables in the next 5-10 years? Is it going to take longer? Just kind of adding scope on how you think that will play out throughout the world in the coming years.
Yeah, and I think your point on Saudi Arabia is fascinating, isn't it? Because, that would be a country where you could sort of say, well, I could bury my head in the sand and I could think it's all about oil forevermore, but they're not doing that, right? They're fully recognizing that we're going to need diverse sources of energy for many, many years to come. And they're trying to work out how they can be at the forefront of that. And again, it goes back to diversification. I think it's a great case study for students, right? In terms of an economy that is looking to diversify itself away from being overly reliant in one place. And I think, again, you can sort of take that principle and you can apply it to lots of places because, again, Europe has had this challenge, to your point, that we've got a lot of manufacturing industries that are terribly dependent on cheap energy, right, in terms of being able to deliver decent returns. And the problem is, if you are looking for cheap sources of energy today in the world, you've broadly got the choice of China, Saudi Arabia, or the United States. And so, that's a problem, right, in terms of getting and attracting manufacturing in Europe. And so Europe, as you say, kind of had to learn the hard way through getting some of the supplies cut off at the start of the Russia-Ukraine conflict. And so the strategy now for Europe is about, okay, how do we diversify? How do we become less dependent? And that same theme, by the way, is reshaping all sorts of supply chains, right? Not just energy. You've got, and obviously, a massive parallel here in the world of chips, microchips, the chip war that's ongoing, right? Nobody wants to be overly dependent on any one sort of narrow supply chain or, set of arteries, as it were, to the world. So I think there's a lot of important lessons around resilience. And in many ways, I think the sort of ESG sustainability backdrop is morphing and evolving and shifting to being about, sort of exactly that resilience of supply chains, resilience, diversification. I think when you think about energy, and I look at our own commodity team's forecasts, right? We're in the category of being more bearish around the the oil markets, because we think there's more supply than people realise coming on over time. We think demand is probably, in many cases relatively muted. I think, offsetting this, you've got that tremendous investment that needs to happen and is happening. We can debate whether it's quickly enough or not, into electrification, right? And again, different countries are leading the way here. China, as we know, is at the forefront of this, whether it's through EVs, whether it's through solar, and the rest of the world has now got to figure out how does it compete with that. And we know that obviously China's got into this very strong position through some really focused government policy and industrial policy around protecting, growing, funding some of these industries, getting them up to scale. And so I guess without that, other parts of the world are going to struggle to compete on that same basis. And I think that's why what's happening in the US in terms of industrial policies, and within that, tariffs is one lever. There are many others. But I think that is going to be something that is going to be a huge thematic over the course of the next few years. But I do think you're going to see this broad diversification in energy, and I think that's got massive consequences for the world and how companies invest. And I think, if the US goes down this sort of path that we're on in terms of tariffs and a whole set of negotiations around, if you like, market access, it could be environmental factors, it could be, all these other barriers to trade, I suppose, that different countries around the world have had. If we're sort of resetting and reshaping some of those relationships, often on a bilateral basis, but with many knock-on impacts to other relationships, then all of that is going to change how people think and how companies think about where to invest, where to build that next manufacturing facility. I think, like the whole data center debate, it's going to be really interesting in how a country like Saudi Arabia might offer solutions to countries like America, right? In terms of come here, put up data centers, potentially, I know you've got to think about desalination and other things, but they're absolutely brilliant across the Middle East in running big scale projects in a highly disciplined, structured way. As we know, in places like the UK, Europe and America, the sort of NIMBYism concept makes it really tricky to do some of these things. But we know that despite all the innovation in AI, you mentioned DeepSeek, and we're obviously going to continue to see improvements and efficiencies in that space, but we're still going to need huge amounts of energy. And, again, I think there's certain countries in the world that are going to structurally have a massive advantage here, and they need to use that advantage, but then also be clever enough to think about what next for them, right? How do they then leverage that advantage but continue to diversify their own prospects? Because every country and every region is going to be thinking about, what has it got itself? What is self-sufficient, at, whether that's food, whether that's energy, whether it's manufacturing base, whether it's services, versus what are the things where you have to work with other folks around the world. And, I think that whole set of relationships now is going to be much more important for analysts, buy side and sell side, to understand, because it's going to lead to potentially a whole series of adverse supply and demand shocks over time that are going to have some pretty major consequences.
Growing up, I was born in 2004, but throughout the 1980s, 1990s, early 2000s, the 10s, there was always this big talk in the back of my mind, overhearing my parents and teachers talk about how China was the number 2 biggest player in the world, and it was having these huge levels of growth year on year. And so it wasn't a matter of if, but when it would overtake the US and being the biggest economic player in the world. But over the past couple of years, China's growth is starting to slow. I think it's slowing this year, it's slowing next year. I don't know whether that's, a trend or just a one-off and it'll maybe come back up. But it makes it very apparent that the US is still the biggest player in the short to medium term, and perhaps even the longer term. On the I would love to talk a bit more about the US and your thoughts on that. And for any listeners that don't really have context, obviously you have Trump's been adding tariffs. He's been adding that on Mexico and Canada, but they've been delayed for 30 days, as you previously mentioned. He's added a 10% tariff on China. He's added a 25% tariff on, I think, aluminium and another metal. He's trying to end the Russia-Ukraine war. He's also trying to end the Israel-Palestine war, offering to buy Gaza. companies are trying to be less reliant on China for supplies. There's been a rise in protectionism, with governments prioritizing self-sufficiency over globalization. And there's constantly the question of whether the dollar will remain the world reserve currency, as other countries such as Russia and China have tried to make their own currencies the world reserve currencies. So there's no need to speak about any of those specifically or touch on all of those topics. But I would just love to get your perspective on what you think the outlook for the US looks like. You talked a bit about we could talk a bit about the dollar, about treasuries, and also what you think the US economy will do in terms of equities in the coming year and years moving forward.
Yeah, you've hit on so many important themes and trends, Harvey. And most of my career, when I look back, I was a luxury goods analyst at Goldman for a period of time, which was a job I loved and found hugely fascinating. And that gave me a lot of opportunity to travel to China, not just the big cities, but tier 2, tier 3 cities, seeing that growth story in action, right? And I found it absolutely fascinating. And it was such a big part of those companies' strategic journey was that growth. Again, it sounds quite old school to say, but in the physical stores that they were putting up in China at the time, and you almost couldn't, the best way to think about investing in the space at that time was who was throwing down most capex most rapidly, right? Was the company that was benefiting from that revenue uplift most materially and that sort of margin accretion. So, I grew up in an era where that sort of whole globalization story was seen as hugely positive. And again, I worked with Jim O'Neill, who was an economist at Goldman, who coined the phrase BRICS. And we absolutely, during that time as a group of analysts, lived in a world where we thought that everybody was essentially like westernizing, and again, it perhaps seems naive now to people listening in at this and thinking about it. But, in many, many ways, everybody thought that countries like China might look over time more and more like the United States. And I guess one of the things I get from investors today is the sort of broader posturing that it's almost becoming the reverse? We had Trump talking about Panama and Canada and Greenland and things like that. And so people are sort of saying, well, is the US starting to look more like, in certain outward aspirations, like other countries like China and Russia, rather than countries like China and Russia looking like the US? And as you know, right, the US for a long time was absolutely the country that sort of held up the world order and was the key underpinning to many global institutions. And I think what the new administration is saying is that they feel, the dividend from that what they've done there, hasn't been, to their minds, great enough, right? And there's this sort of question mark over what's happened to America's manufacturing industry and jobs for middle America, and that's sort of hollowing out. And although they've had tremendous success in the services arena, you can debate what's happened in the manufacturing space. And I think there's economists on both sides of that argument. Some who will take the view that actually it was, inevitable that as manufacturing became more automated, jobs would go, and others who say, well, look, too much of that manufacturing space was outsourced to lower cost locations, and that was a massive benefit to consumers in the form of lower prices. But the price paid from a sort of jobs perspective and the knock-on issues that has for society was too great a price. So there is a sort of recalibration, if you like, of that world order. And I think everybody's grappling with what does that look like and what does it mean? But to sort of try and go back to your question and think about, I suppose, where the world goes from here, I think it's quite a complicated set of issues that we face, right? Because ultimately, when we look at, say, China, for example, we have a whole range of challenges that we can see, right? Obvious challenges, and people use the term like, is there a risk of Japanification for China? Aging population, too much debt, overly reliant on government sponsored investment, the kind of like roads to nowhere narrative, too dependent on the property sector. And, there's obviously, like with everything, right, there's some elements of truth to those structural challenges, but also you've got to look at what they're trying to do, right? They're trying to rebalance their economy, and they absolutely use trade and manufacturing to their advantage to lift hundreds of millions of people out of poverty. And they did that very successfully, like in a record-breaking way for the world. And I think sometimes we forget that. And ultimately, they're trying to rebalance and shift into more advanced manufacturing, higher growth sectors. But these things take time, and these are difficult transitions. And so, I don't think it should be any surprise to people that you've seen these incredible sort of AI tech breakthroughs coming out of China. I think, like with everything, right? And you were saying earlier, you always have to treat every bit of information we get anywhere in the world with a healthy degree of skepticism. And part of an analyst's job is to question and is to say, when they see data like that coming out, is it reliable? Is it accurate? What does it really mean? And I think we're going to see a whole host of that, those questions, those challenges. Did that model really cost this much, and what was it really trained on, and all those sorts of things. But nevertheless, I think what you can say with conviction is there's very much a sort of AI tech arms race that's going on at the moment. It looks as though it's very centered around China and the US, and I think there had been this broad view that China had been left behind, perhaps during the pandemic, some of that due to zero COVID. And I think people had thought probably before the pandemic, China was pretty close to the US in many ways technologically, and there were certain benefits of the structure of their economy in terms of that ability to gather data. I think what happened, obviously, as we went through the pandemic, is it forced a lot of the parts of America that had been very hard to shift, if you like, fully online, fully digital, fully mobile, to really make that leap. I mean, again, you probably remember, Harvey, pre-pandemic, you'd go to America and it was still very like cash centric, compared to other parts of the world, it was sort of surprisingly so. And then obviously the pandemic has sort of pushed some of those things over the edge, as it were. And I think that has helped in many ways to sort of digitalize and innovate again in America. So I guess the big conundrum for everybody is going to be, how this all pans out, particularly around the semiconductor, the chip ecosystem. I think everybody's been questioning, the capex, as you say, of some of these big hyperscalers, what the returns on that capex are going to look like, what kinds of productivity benefits we're going to see. But I think also, at some point, the new paradigm for some of these trade conversations, which today are very much rooted, I think, in, deficits are sort of bad, part of how it's being viewed, and you want to get to balanced trade, with a heavy weight being focused around manufacturing and bringing manufacturing back to countries like America, and people wanting to control more of those supply chains. I think it will start to shift to other things like services too, because don't forget, the US is an absolute leader when it comes to exporting digital services to the world. And so I think, how those debates and discussions shift over time are going to be some of the really critical themes that are going to drive the investment narrative for much of the next 3 to 5 years.
I've got one last markets question, and I've got 4 last quick questions about you. The last markets question, and you don't have to, I know this is, again, quite a big topic, so there's no need to go into as much detail because just time-wise, is AI and cryptocurrencies. Both of those are incredibly big topics. Crypto in particular was achieving incredibly high valuations in 21 to 22, and then that kind of died down a bit and is coming back up again. Similarly with AI, it's kind of like at its biggest moment right now, with the likes of NVIDIA, with ChatGPT. Elon Musk is also trying to compete in that space. On the AI front, is it really as big as we think it is? And who do you think will win the AI battle? Will it be the US, Europe, China, or someone else? And similarly with cryptocurrencies, more from an ethical standpoint of things, a lot of illegal organizations use cryptocurrencies to basically be able to manage their businesses off the books. So to what extent do you think big funds should be looking to invest in cryptocurrencies from a pure returns perspective, whilst also having that unregulated aspect in the back of their minds?
Okay, so let's start briefly on AI. I think the AI space is evolving really, really rapidly, and obviously, we, like lots of firms, sort of said to clients, look, you got to think about, who's got the dollars to invest here, and then ultimately, what are the returns on those dollars, right? As you build out the infrastructure, you lock in the access to the energy that you need to do that, and obviously, again, the vertical integration that you've seen there is interesting. The different country level alliances, some of which we've touched on, is going to be fascinating. I think, then it starts to shift into applications, right, and into software and into that space, and which are the companies that are able to actually really monetize some of these things. And again, I always think, like with everything in life, you have to look at it really in a sort of simplified way. And if I look at it in my own little world, right, and I think about how we're using AI within research, we get inundated with people offering us AI solutions, right, every week. But again, if we took up every single opportunity to run with some of these software licenses and experiment with all these different products, I'd burn through my technology budget pretty quickly, right? This isn't necessarily cheap, and I understand why, because they've had to invest a lot of money, and it costs them a lot of money to do the training, to buy the chips, to do everything else, right? If you go back through the processes, and again, the power piece, etc. Now, look, what we're seeing is some of those costs will come down, efficiencies will come through. But also, if you think about it, like the things that AI is doing for you today, even if you think about it at an individual level, it probably doesn't feel as transformational yet as it perhaps will do in a period of time. So if I think about how I use it, in my personal life, I might use Claude or ChatGPT, and I'll ask a question, and there's an awful lot of questions that are still not totally accurate, right? When you ask the question, you get a slightly strange answer back, and you have to sort of re-prompt, and then it'll correct, and all of those things. And so, there's an awfully long way that it needs to go yet in terms of that learning to be more useful. And again, most people that you'll probably know, sort of socially, probably just use the free stuff that's available. Like, not many of us are actually necessarily paying up for it today, but over time, more and more companies will take on more licenses. Then there'll be, obviously, so there's who's going to win in the enterprise space, and there's going to be like who's going to win with the consumer, and what does that offer look like. And I think there's still an awful lot of unanswered questions there, but there's the sort of bigger, broader, longer term questions. It's a little bit like, I suppose, the classic parallel is sort of driverless vehicles. Many times, if I look back, say 10 years, we all thought that by this point in the future, the world would just be full of driverless vehicles. And in reality, it's been harder to get the full benefits of the technology than people thought. And some of it comes back to ethical and moral questions, right? It's like, who does the driverless car protect? And it's, those really big, difficult questions on, are you saving your driver, or are you saving the person that's walking down the pavement, and why, and all of those things. And so I think, there's going to be a whole host of discussions around AI that relate to some of those more ethical, moral type questions as we get going, right? And we'll get there, and I think there will be a massive productivity gain, and I think eventually returns on the investment in the space will start to look good. And the companies that are able to get their data into good shape so that they're in a easy place to efficiently put AI into action to save both costs, but also, more importantly, to genuinely deliver revenue synergies, because you're giving a consumer of your product a better experience, like, they're going to be the winners. And I think that's why this sort of broadening thesis in the market holds as well, right? And I think there'll be many more applications of this, and there will be more bifurcation within industries around companies that are winning and losing. And I think that, again, goes back to probably why it's maybe a good period of time for an active manager resurgence in many ways, because I think these things are going to be quite hard to predict and to forecast. If we pivot maybe to digital assets, to crypto, again, in 2021, we look quite hard at this space because we had a lot of clients asking us, what do I do here? How do I think about this from an asset allocation perspective? Is it even an asset class given it's, is it a store of value? It doesn't have a yield. How do I think about it, right? And there's obviously a number of people out there that would argue that it isn't yet an asset class. It's more speculative than that. I think what we would say is that clearly some of the blockchain technology that exists is going to be hugely valuable, and it's going to be fascinating how that develops. I think, maybe a few years ago when we started, we had a small team at Citi that we started back in 21 dedicated to the space. We started writing about it. We used to publish, and we still do, Bitcoin, Ethereum models, just to give clients an understanding of how you can start to think about these, different coins that exist. And there's definitely some hype out there where people would say, every bank's going to have loads of analysts forecasting all the different coins. Well, in reality, that was always going to be difficult given your point on the regulatory regime, right? And so although we've started to see with a number of the big asset managers, there's been some movement in terms of obviously crypto ETFs and things that have been approved and have had huge traction, right? Everyone wants to know, where does that go next? What does that mean next for the space with the new administration? But the regulation around it is going to be really critical to determine who can play in this space and then where it goes from here. And so we'll certainly, be waiting and watching to see how that evolves under the new administration in the US, but also around the world, because there's still, as you point out, a number of concerns about the space. And I think until you've got a really good, it's a great example of, right, you don't want to be so lax with a set of regulations in an industry that people don't have that trust and faith in it, because ultimately that's really, really important for the success of any asset class or any industry as it's developing. And so there's got to be some pillars put in place to think about how these coins get regulated and how the infrastructure and the platforms get regulated. And so, I think clearly smaller, less regulated firms are already moving into the space in significant size and scale. But for the major banks, the major asset managers, it's going to be governed by how the regulatory backdrop and regime evolves over time.
Yeah, I think the regulatory point is really interesting, because even the President of the United States has released his own coin that achieved a market cap of more than 9 billion. His wife made one that achieved a market cap of 190 million. And it's like, to what extent of, maybe it's legal, but is it ethical? And I'm interested to see how that plays out moving forward. I think something I kind of have to ask you that I haven't already, and you kind of got to the scope of it at the start, speaking to someone that's achieved the sort of heights within this career, is how do you go about actually telling a good story? How do you sell? What makes the constructs of a good story? Because as you said, getting into people's brains and actually getting them, staying front of mind is incredibly important in this business. And you're obviously at the top of it. So how does someone like myself, someone getting into it, or even people in the industry, go about telling a good story?
Yeah, I think, the sort of storytelling art is possibly a little lost, isn't it? I was talking to someone today, we were talking about our children actually, and we were just saying, how when we were growing up, we used to love sort of hearing stories from our parents and our grandparents about what it was like in the olden days, right? And, sometimes I feel like my kids are a bit less interested in that because they've got so many other interesting things that they want to watch and get engaged by, right? To the comment on how content distribution and creation has changed. I think what you've got to do as an analyst or as any individual is you've got to figure out your own strengths and what you like to do and how you like to communicate and put a story forward. And, as I said earlier, there's so many different ways you can be successful in this space. But my big recommendation to people is listen and learn, right? The availability of great podcasts like yours where you can listen to amazing people that have done amazing things, right? And you can figure out yourself, what is it that you want to do? Who do you want to be? It's not always what you want to become or job wise, what you want the CV to look, but it's who do you as a person want to try and be? And I always think that's quite an important frame of reference is to have that, because then you can listen and look out for people that inspire you, motivate you, and you think, yeah, no, I like that. That's sort of my style. That set of values that person has, that reflects what I want to become. And I think immersing yourself in that is really important. I think, one of the sort of secrets to happiness that a lot of the sort of experts in the space talk about is that authenticity, right? And a lot of people would suggest that if you try and be this kind of person at work and then you try and have a different persona in your personal life, that disconnect makes it sometimes really hard to be truly happy. And we thought a bit about this, when we're trying to encourage people at work to bring their sort of whole self, as it were, to work and all these things. But I think it is actually so important that you figure out who you are and what you want to be, because then that enables you to bring more perspective to different situations, right? So when you are out there telling stories, trying to hold attention, you can bring them to life more, right? And I think you got to listen to lots of different sources for inspiration on how to do that, because not everybody's a natural showman. One of the things that we try and do is encourage a lot of our analysts to spend time with some theatre production companies, right, who give people tips and tricks for getting out there, holding an audience attention. And I think sometimes that's really good. And that whole bit of advice of like, fake it till you make it, I think that's important. I don't think it flies in the face of being authentic and being you. I think it's just another tool in the toolbox that you have, right? So that if I've got to give a presentation to 50 people, how am I going to do it? And there are brilliant teachers out there who are on a whole host of platforms and podcasts, and you've got all of that at your fingertips today. So you've got to leverage that. And I think it's a really important part of becoming successful, particularly in finance, right? And standing out from the crowd. And I think, it's like doing what you've done, right? You've been really innovative getting this podcast off the ground, and you're going to be able to use that and carry that with you as you go forward in your career. And it's a great way for people to get to know you, right? And getting to know people always de-risks hiring decisions. And so I always think, when you're going to think about a job interview or a role that you might want, or you're trying to figure out how do I get from here to here, you've got to think about it from the perspective of the person that's the decision maker, and being able to sort of de-risk things and show them, well, this is what I've done. This is where I'm proven, and I've built these relationships, and this is how I can apply stuff. It's so important. One of the earliest jobs I ever did was I was a double glazing salesperson, briefly, which was in a basement of a building back in Shropshire, which is a fairly soul-destroying experience in some ways, because 99% of the calls were no. And a lot of people didn't even say no, they just put the phone down, right? But it taught you that level of like grit and resilience. And it's like, okay, keep going. And I used to say to myself, okay, how can I be a bit more interesting? Like, how can I get a hook into this person, right? And it's all about knowing.
It will change your life. It will change your life.
Yeah.
Double glazing will change your life.
Exactly. But, that's the thing. That's why people in interviews used to say, sell me this pen, right? Because they were trying to test for that skill set.
No, exactly. I mean, my third final question, if I was to ask someone in 100 years' time how they would describe you, what would you want your legacy to be?
Oh, wow. Yeah. Look, that's a tough question for everybody, and it's probably one that most of us don't think about enough, right? I think we probably all recognize that most people don't get to their deathbed and say, oh, I wish I'd spent more time at work. Most people, what they remember in life is connection, community, family, and all of those things. And so, I definitely think about that. I think about the pillars of life that you need to be successful. It's not just about career, but it's about broader health and wellness. That includes, obviously much more commonly known today, but sleep, exercise, nutrition, like all of those pillars have to be in place and working to have a sort of fulfilling life, right? And then you need to figure out, what are the things that you want to do? And I suppose for me, when I look forward, I would love to leave some kind of lasting impact. I think there's so many different places where you can do that. For me personally, like education is massive, because I think when I look back on my career as someone without a lot of connection into finance or the city, it was only possible through great education. And through some great teachers who inspired me, and a whole bunch of other people, my dad and others, that inspired me to do certain things. And so how can I leave a legacy that gives some inspiration to people that maybe don't have as much? And I think that's a really good question for lots of us to consider. I definitely think education is this great equalizer. And so giving more people access to better education, to hopefully be inspired, to learn more, to keep learning, to come up with innovations and solutions to some of the world's biggest problems. You can't go far wrong with that. And so for me, I do a few things away from the day job that is sort of board work, with my old university and with another university in the United States. And I'm pretty passionate about that. So I suppose the kinds of legacies I'd like to think about building and leaving over time revolve around that, and revolve around changing lives of young people through education and through other things. But then also, for me, I've got 2 kids, and I'll be really interested to see where the world goes for them and for their families. And so just staying relevant, right? Staying engaged, wanting to keep learning, wanting to keep challenging myself, trying to stay fit and healthy as you get older. Like, all of these things are full-on battles that we all have to face, right? It gets tougher and tougher as you get older, and I think you need more and more of a concerted effort, because I always sort of, it's interesting when you think about it, right? There's more information and knowledge out there today than there has ever been before, and yet the reality is bigger groups of the world's population are sicker, unhealthier, and unhappier than they've ever been, right? Particularly in the West, particularly in cities. And so you have to, I think, wrestle with why that is and what we can all do individually, for yourselves and for your own friends and families, but also for the teams and the work communities that you build and run. How do you change that? Because that's really important in terms of where we all go from here.
I love that another university was Harvard University. I'll remember that one.
Yeah.
My penultimate.
I thought I should say that, given you're at a university in the US.
No, exactly. Competitor of Duke. Yeah, maybe one day we'll get to Harvard status. Who knows? My penultimate question, and this can be on any forward-looking scope that you look at: a year, the next day, 10 years. What's next for you?
Well, it's a good question, Harvey. I mean, I love the firm that I'm at today. I find it really fascinating. I think there's huge opportunity and runway for people that are hardworking and are at Citi. I'd hope that includes me, and I hope that there's more things I can do for the firm beyond what I do today. But I'd also say, I try not to close myself down to any opportunity, right? And I think I definitely spent a middle part of my career where I was very much like head down, in the weeds, trying to be the best I could be at the day job. And I probably lost a little bit of the broader network and connectivity. So I'd always encourage people to think about your network and how you cultivate that, not just for your own benefit, but for the benefit of other people. So I don't really know what's exactly next. I hope it's taking this team on to some new heights, and there's definitely loads of opportunity, I think, for the research franchise at Citi to go to the next level with some cutting edge events, and hopefully being innovative in the types of content we write and how we distribute it, to some of the conversation we've had today. Because also, like lots of people, I have that desire to sort of be a little bit entrepreneurial, to try and create things, to build things that are different and innovative. And so, I would certainly like to try and do that where I am, but also continue to try and add some value to some of the other organizations, such as, Birmingham and the Harvard Kennedy School, to help some of those institutions as well. Sort of think outside the box, think about what's next, and what great looks like for the next generation. Because the one thing that's for sure is it's going to be fairly dramatically different to what great looked like in the previous 5 to 10 years.
If you're ever struggling to find an interviewer for any of your events, doesn't matter where it is in the world, I'm there. I'll happily do you a favor, be your interviewer for the events. That leads me into my last question, and I ask this to every guest on Personable, is what is one thing that you would want a listener to take away from this episode?
I would hope that the listeners would take away that finance is a amazing industry to join, right? There's loads of great firms, there's loads of great areas within finance to explore. And if you're intellectually curious and you want to know how the world's going to work and how it's going to change, it's a brilliant place to come and be a student and keep that learning for life mentality. I would like listeners to take away that if you are thinking about joining an investment bank, consider research, consider that not just as a place to learn and grow in the early stages of your career, but to build a career and often, come back to after doing other things, because I think it's just, again, it's one of the most innovative parts of a bank, because you've got that license to think differently, think out of the box, and think how things are going to change and evolve over time. And hopefully people take away that, careers and life, they're never linear, right? And there'll be many ups and downs, but ultimately being resilient, having that grit, coming back with enthusiasm, building a network, doing all of those things, it always pays off. And having that broader holistic balance too, all of that matters.
Yeah, I think I think we touched on a lot of different topics there, from AI to the US to China to Europe. And there's only, so much we can talk about trying to move from topic to topic in such a short period of time. But if anyone is listening to this that does have access to Bloomberg or CNBC or any other channels they go on, I would listen to what Lucy says. It's not much coming from me as a student, but if it means anything, she's definitely the best of the best. So I would definitely listen to what she has to say. Secondly to that, the importance of giving back. One of my friends has an economics, like a financial economics professor at Duke, and he works in the city. I think he's pretty high up at Morgan Stanley within fixed income trading, and he flies in every Sunday night, teaches on a Monday, and leaves back Monday night. And I just couldn't understand in my head, why would this guy who's got everything in the world, he has a family, he has friends, come back just to teach at Duke? And you've kind of answered the question there for me, in that it's actually the importance of giving back and having a legacy outside of what you do for work to actually help the next generation to thrive, which I think is incredible. And what you're doing at Birmingham and what you're doing at Harvard, which I think is incredibly excited. I'm excited for your future. Whatever you do, I'm sure will be great. But thank you so much for the opportunity to interview you and to speak to you again. I'm excited for everyone else to listen to this and hopefully gain as much knowledge from this as I have.
Harvey, thanks for having me. It's been great to be part of your podcast, and wishing you all the very best. So thank you.